Welcome, fellow traders. This is Larry Williams, and it's a real pleasure to be here today, sharing with you a little bit of what I know about trading stocks and commodities. This is a new show for me, so if you have questions as we go along, feel free to ask them. You can type them on in there, and then Rachel will let me know what those questions are. I'm going to really break this show down into two parts. I'm going to talk about stocks. What I'd like to do each week is bring up one of the great unknown growth stocks. There's some phenomenal stocks out there people just haven't heard about. I'd like to introduce you to those stocks because there's some wonderful opportunities. They're not stocks that have been much in the news, but they're almost unbelievable off the chart stocks. And then I'd like to talk about commodities because that's what I've really cut my tooth on and made my career out of, is trading commodities over the last almost 60 years. So I'm going to give you some insights into trading commodities. Even if you're a stock guy, there's a way you can trade commodities. But let's start with unknown great growth stocks. One of my all-time favorite stocks is called Jack Henry and Associates. The symbol is JKHY, and I'll bet none of you have ever heard of this stock. It's they do technological solutions and payment services for banks, for the financial industry. They have about 9,000 customers. They have three primary brands of software that they sell. They're a software company, essentially. Forward PE is 34, which is not bad given this market, and they actually pay a dividend, which is unusual for stocks in this group. So dividend 1%, PE at 34, and performance, wait till you see the chart. There it is, going back to 2008. And the stock just doesn't know how to go down, just consistently has gone higher and higher and higher. And I think we're going to see new highs in this stock as well. So that's a long-term JKHY, Jack Henry view. It's just been a phenomenal growth stock. And one of those stocks that very few people have ever heard about. That's what I like about it, because it doesn't have the emotional swings that the public gets into all the time of a lot of craziness. So let's look at the stock a little closer. This is the seasonal pattern of JKHY. You can see where we are right now. We're in the area where we can expect a seasonal low to start developing in this market. We're not too far right in here. You can see we usually see a low about this time in October. So that's good. That's an indication we're getting into the buy area. Is there something else that could help confirm that trade to us? There sure is. I have an index that replicates what commercials would be doing if we use the commitment of trader report for stocks. And you can see the record's pretty strong here. When these guys, that's insiders or funds, have been buying at JKHY, it's gone up very consistently. This indicator has predicted the best times to be a buyer, to get long. We're not quite there yet, but we're really close, which means this is a stock you want to put on the front burner for a potential buying for on a longer term basis, an intermediate, at least 3 to 6 month hold, if not longer term basis. And funds have started, as you can see, to start to accelerate their buying in here. Probably another week or two, and I expect them to be in the buy area. So whatever tools you have, what arrows you have in your quiver of investment advice and indicators, I definitely put this stock on the front burner and start to use the tools that you have to get a good look at the stock as a potential long position. So big question about the stock market is, are we in a bull market or a bear market? That's always the question. Well, I'm going to tell you, we are still in a bull market, which means investors hold. Traders buy big dips and sell big rallies. So the strategy that's worked really for a long time now is the bull market strategy. Don't be afraid of the dips. Use them to accumulate, and then sell on big rallies. Take your profits and move and wait for the next big dip. There's some fundamental reasons. I'm not just a technical chart guy. I really do believe fundamentals. I think that conditions cause markets to move. There's a great GDP, gross domestic product, model from the Atlanta Fed, and it shows that the GDP is expected to be 2.1%, which is really good, up 1.9% from September 18th. GDP is really good. Good growth for the economy is good for stocks. So to see Atlanta Fed continue suggesting higher GDP rates, very, very bullish. But there's a better indicator that I think, and that's my recession indicator. I look at a lot of recession indicators. One of the best is just job, because if people don't have jobs, they can't buy stuff. If they can't buy stuff, companies don't make money. So a couple of ways of looking at that. The hourly unemployment numbers are in red, And those tend to be the first because hourly people are laid off. And you can see in the red that it started to come down earlier than the overall unweighted. That's in the blue line. That's been a good leading indicator of the economy. When people are getting laid off, hourly jobs get laid off first usually. And this is where we are right here, right now. We don't see any big divergence. They're both pretty much hand in glove positive. Even more important, though, is to follow job switchers. These are people that are switching jobs. Why do you switch jobs? Because you think the economy is going to be better. You can get a higher paying job. I don't know anybody that switched from a higher paying job to a lower paying job. They do it for reasons. Well, we can see in 2008, as soon as the job switchers stopped switching, a strong uptrend, right? Once they stop switching, they know they got a good view of what's happening. This is where we are now. Job switchers have just made an all-time new high since 2010. They're still switching, which means the economy is still strong. Once that rolls over, the economy is not as strong. But to see what we've seen in the unemployment numbers here, I think is fundamentally very bullish. So the future, where now, what next? We have kind of a background here, a scenario of one good stock to look at and a fundamental background, but I'd like to show you what I think the future is for stock prices. I do a lot of work on cycles, not just fundamentals, but cycle forecasts as well. And my cycle forecast is saying we're seeing a dip in here that's a pullback. We should rally in the end of October. And this is the good news. Around the middle of November, we're going to have a really good, strong year-end Christmas rally. There's been a pretty good forecast, generally speaking, when we should top and bottom in the market. We should continue to see a bit of another maybe a day or two decline in the market we're in now, a rally through the end of October, and then the Christmas rally. So I'm getting ready now for the Christmas rally to find stocks for that. A lot of really good stocks. We'll be talking about that in forthcoming issues of this. One of the very best, without a doubt, maybe the best time of the year to take some great long opportunities in the stock market. I look at stocks to see if they're under accumulation or not, as smart money started to buy it. And if we look at that, this is my commercial indication for the stock market. When it's high, there's always been a very good time to buy stocks. And we've just entered a very high zone. So right now, the stock market is under accumulation by what I would call informed money. Notice they got out back here. They got out in here. They got out here shortly before the top. They got out here and here. They got out here. They're very astute at their buying and selling in the marketplace. And right now, they've been buying. So while the stock market's coming down, I don't think this is time to be frightened. This is a time to look for buying opportunities. I'd like to talk a little bit about exchange traded funds, because this is how commodity guys and stock guys can get together. So what is an ETF? It's a fund that's fully invested in one or more assets. Now this is where it's really critical, one or more assets. Because if they're just in one asset, these ETFs could be in just bonds or just crude oil or gold or just the dollar index, or ETFs then become something that stock traders can trade representing the underlying assets. So you don't have a commodity account, but you're interested in gold, you can buy or sell a gold ETF or crude oil or whatever the commodity you're interested in. Now, stock guys and gals can become commodity guys and gals. That's the big point. And this ETF growth has been absolutely sensational. They've grown now about 25% annual growth. There's now over $4 trillion in these ETF funds. They really caught the imagination of the public. Say, why buy a portfolio of 10 or 15 stocks when I can buy an ETF that represents the Dow or the Emini or the NASDAQ, or an ETF that represents gold or wheat or corn or soybeans? So it's a way of allowing stock people to trade in the commodity markets. And that's been a really big door that's opened up for us here. These future trading funds or ETFs are fully invested in only one asset. Could be gold, soybeans, copper. So now stock guys and gals can, in fact, trade futures. Excuse me. Here's the best ETFs for stock traders. For gold, the symbol is GLD. Bonds, TLT. Crude oil, USO. For stocks, SPY. And for the dollar index, UUP. So there's the best of the ETFs to trade for the major markets. These are the biggest trading markets in the world. Gold, bonds, crude oil, stocks, those are the big future markets. Then maybe the dollar index. And after that, the grains and the meats and coffee and cocoa. Those are all there. But these are the big ones that I wanted to focus on today. Those are ones you can get started on. Now, there's an interesting point about these markets, though. Well, this is a chart of the actual physical contract of gold, and it looks very similar to the gold ETF. They do trade together, so they look very similar. Here's bonds, and there's the bond ETF. They do trade together, yet they trade differently, and I'd like to explain that to you today. Here's the actual Treasury bond contract. Notice it's pretty consistent, large ranges, and if we look at the ETF, look at all the gaps in here. The reason for this is that the commodity market is essentially a 24-hour market. Now we close, we open a couple hours later. The stock market, though, which TLT, the ETF trades in, closes here, then the future markets opens up and it does what it's going to do, and then stocks catch up with it, so we get big gaps. So you see big gaps in the ETFs. See those big gaps in ETFs? And we don't see them in the Treasury bond market itself because there's no closing, essentially. We have no overnight close trading, whereas we do in the ETFs, and that can make a big difference. So the question is, how do you handle that? Here's another example. This is a crude oil. Again, notice we don't see any gaps here, but if we look at the ETF for the crude oil, look at the huge gaps in this marketplace, really big gaps. So that can present a problem for stock traders. How do we handle that? A couple of things. We use momentum and trend tools, and you want to be more of a position trader based on market conditions in the ETFs than you do in very short-term trading in the commodity markets. Or, of course, you could become a future trader. But the big thing is that these ETFs do trade differently on a short-term basis than the underlying asset, the actual physical commodity, gold, crude oil, treasury bonds, wheat, whatever. So you need to take into the consideration the technical differences between these markets. So let's look at one potential trade. This is the Japanese yen currently on a weekly basis. And our index of commercials, these are the largest users and producers of the commodity market. Notice when they're down in this area where they are now, the markets usually come down. When the commercials are selling, as they were in all these examples, the market comes down. When they're very high up there, they're buying, the markets rally. That's how commodity markets work. Another point is that the seasonal pattern to go down now, we see a seasonal tendency in Japanese yen, is to go down. So seasonal tendency is down and the commercials are not buying, they're down in the sell area. We're probably looking for a potential sell in this marketplace. And then I like to look at cycles in the market. This is my cycle forecast for the Japanese yen. And you can see it's done a pretty good job of telling us the overall roadmap, and that's what I use this for, a roadmap of what to expect. The expectation we can rally here in October, but then we've got a pretty good decline coming based on cycles in this market. So that to me is an interesting combination of ingredients. I like to look at the technical aspect. So I see, the commercials have been buying or have been selling this market. They're down in this area. Seasonal tendency is turning around now. We start to go down. We see a cyclical forecast. Then I could start to take a trade in the ETF. So that's why I like to approach this, is to look at a combination of ingredients, and then I can take action in the actual physical contract or in the ETF itself. Gold, oh my gosh, what a market this has been. Such an emotional market and a very tradable market too. I'd like to teach you a few things about trading gold today. First of all, this is what I think is going to happen to gold, where we are right here, right now. This is my gold cycle forecast. A cycle forecast I've been working with, thinks, gold should start to come down. In fact, it's done that. The cycle forecast is just this decline we've seen in the gold market, this pullback or correction should last until about the end of October. Now, it doesn't mean we come straight down. It just means there was a buy point here, a sell point here, a sell point here, and a nice buy point coming up around the end of this month in the gold market. So gold bugs want to be looking very adroitly for an opportunity at the end of this month based on cycles. And those who have been shorting gold If they didn't cover them on the big break, want to look for maybe one more downdraft in this market. But certainly after the middle of this month, especially towards the end of the month, you don't want to be looking to be a short seller of gold. So let's look at our charts on a closer basis. If we look at the small speculators now, these little guys in the market, this is the public. This information is released by the Commodity Futures Trading Commission each and every Thursday. We get it on Friday, and it shows what the small speculators are actually doing. I make an index out of this. When the small speculators are really bullish on gold, as they were here and back here and here, gold comes down. By the same token, when they're not bullish at all, they're very bearish. They were doing a lot of selling in here, a lot of selling here, a lot of selling over here. Oh, I should almost laugh at these people, right? A lot of selling here, gold rallies. So the small speculators in the gold market tend to do the wrong thing most all of the time. That means it's a good indicator. So right now, they've been really, really bullish on the gold market. To set up that buy point coming in October, I'd like to see the small speculators get down here in the area where they don't believe gold's going to go higher. That would confirm the trade. Also, the blue line is a seasonal pattern. Notice there's been a pretty distinct seasonal pattern for gold to rally around the first of every year. There's the first of 2018, first of 2017. So we're getting into the seasonal sweet spot for gold as well. Typically, it starts to decline this time period, or pretty much following the seasonal forecast. So watch for the small speculators or any sentiment indicator to show that the small specs, the uninformed public, has started to walk away from this market for a buying opportunity. Treasury bonds move the world. I mean, my gosh, interest rates in America really set interest rates for the entire world, which means we move the world with interest rates in America. It's been a great market. I'm going to add another layer now. We just looked at what I call the green line guys, the public, right? But we can also overlay that with the red line, which are the actual commercials. These are the banks, the hedge funds, the biggest money in the world. This is what they're actually doing in real time with their money. And as you can see, when this red line is high, we have been at some really nice buying opportunities in the bond market. And it's currently high. Not only that, the small speculators, the green line, they were not buying at the bottom down here at all. One of the best buying opportunities ever in the bond market. And they've just about broached that point now. Again, you can see where they're not buying and the commercials are buying. We rally. Same thing down here. Same thing over here. Commercials are buying, public's not. Got about a month and a half rally. And another opportunity where the green line, the small speculators, just didn't want to buy treasury bonds. We formed a huge base and had a big rally for about 6 months. So we're currently in this juxtaposition where the commercial has been buying and at high price levels. That's quite bullish, while the public is not interested in being a buyer in the bond market, and that is very bullish. So what did cycles tell us about this market? Let's take a look at that. Cycles, I think, are telling us that we could have another little downdraft in here, but kind of like gold, around the middle of this month, we're going to see a buying opportunity in the bond market. Again, cycles just go from peak to trough. They don't tell us the magnitude, the move's going to be this big or this big or this big. They just say buy point here, sell point here. And they're telling us we're getting close to a buy point around the middle of this month. So we want to really pay a lot of attention to this. Maybe on next week's show, we can get to our daily charts and find a buying opportunity. But definitely, this is a market I'm putting on the front burner of my stove. Heating oil is another market that's really interested me over the years because that is a strong seasonal pattern. You can see that right here. Around the first of the year, when weather starts to get cold, heating oil starts to turn up in the marketplace. You can see that's been pretty consistent, hasn't it? So around the first of the year, this market's been a bullish market, but about now it's come down. It's come down a lot in October, November. So is there a reason this year to expect that market to come down? Oh yeah, there sure is. Again, remember the red line are the commercials in the marketplace, and when they're buying, we would expect the market to rally. Well, they haven't been buying. They've been down here selling. And the public, they're kind of mixed. They don't know whether they want to be a buyer or a seller. But since the commercials control these markets, I've got to think that with this seasonal pattern this year will continue. Therefore, traders in ETFs, in the energy complex, or in the actual futures should be looking for sell signals. And here's my heating oil forecast. It also suggests we should continue coming down at least until the middle of October, if not the 1st. So look for lower prices in the energy markets. If you like what you've seen, come learn and trade with me. I do a weekly market commentary with buys and sells. It's $30 a month. There's a lot of free stuff too on our website, ireallytrade.com. And what really I'm about, and I want to go over this again, is not just technical stuff. And there's a lot of information on our website that is free that explains that there's more than technical to the marketplace. Let me again explain what I'm talking about here. The fundamentals are the conditions that cause markets to move. That's what make markets go up and go down, not charts. I don't think charts cause anything. Charts are a reflection of what happened. So if I can see when the commercials, that's this red line, the commercials in the treasury bond market, again, are banks and institutions. If we look at the commercials in, say, heating oil, that would be the users and producers of massive energy companies. When these people are aggressively long in the market, the index shows they're at 100% buying of their maximum buying, we expect markets to rally. So it's the conditions, and that's what I like to talk about and hope you'll think more about, is it's conditions that cause markets to move. It's not charts, it's not moving averages. Those reflect changes in trend, right? Changes in trend, but they don't show the driving force of the marketplace. It's kind of like the analogy of, I see a ship, I'm in the Virgin Islands, I see a ship out in front of us in the ocean here. And if I look at the waves behind the ship, I can see where it's gone and when it's turning. But I really want to know about the captain and the ship. Where is he taking that market? And that's the commercials. That's the red line. And the seasonal patterns give us a pretty good idea of where the captain is going to drive the market, drive the ship this year. So it's a combination of these things that really help us. We'll take another look in the bond markets. I really want to focus on this. The commercials have been doing a lot of buying in here, and at high prices, that's very unusual. See how they're the driving force of the marketplace? And that's what is significant to understand. The big powers, the big money involved in these markets, when they start to drive prices one way or another, we want to get on board the market. I'll be talking more about this in future weeks because there's a third component here. There's also large traders. I haven't shown them this week, but I will next week. Large traders are funds, commodity funds that are invested in commodities. And they're really an interesting group. They manage billions of dollars, and they tend to be more or less short-term traders, not always, but definitely they're trend followers. So we can get a lot of insight when these funds are coming into or out of a position in the marketplace. We'll be paying a lot of attention to those guys as well. There's three parts of the Commitment to Trade Report. You might want to Google that, Commitment to Trade Report, cftc.gov.com. I was the first person to ever write a book about it. I've been using the data since 1973 when we used to get on a monthly basis. Those are really the driving forces. So as I see it, we have a driving force in the marketplace, and then we have a cycle projection that tells the general when we should expect the next buy point, the next sell point in the marketplace, to put all this into perspective. Because what's helped me over the years in my trading is that perspective of where we're going. Everybody look at the charts and make a decision, but if I have a bias, we're going to be starting to go to the upside and treasury bonds a little later this month. Well, now I know which side of the market to play. And then I can go look and see, is this idea supported by the commercials? If it's supported by the commercials, holy cow, there we go. We really have something going. We've got a message going for us in the market at this time. So we have the direction of the market. We have the bias in the market. That gives us our view of the future in the marketplace. You see the same thing in heating oil. We see the direction of the marketplace, the seasonal pattern is to the downside. So we would expect to see this market start to come to the downside. And is that supported by what the commercials are doing? And clearly the answer is yes, it is supported. They have not been buying. If they had been buying, notice at this seasonal point, we expect the market to rally. The commercials were buying. So guess what? We expect it's going to work. Seasonal tendency to rally here. The commercials were buying. And guess what? We had a nice seasonal rally in the marketplace. So that's what really excites me about the markets, is seeing that we can combine several indicators or ingredients, if you will, to figure out where markets are going. Otherwise, we're just looking at charts, and charts are very deceptive. I've looked at charts going back to 1962 when I first started in this business, and they're really hard to read. And they cause us to become emotional. That's another interesting point. You look at a chart and you think, oh, that's really bullish. Keep this in mind. Most traders, most short-term traders lose money most all of the time. So whatever their reaction is to looking at charts, yeah, it's the wrong reaction, isn't it? So you have to temper your reaction. You look at a chart and think it's bullish or bearish, you were probably 100% wrong, because most traders are. So you need to filter what you're doing in the marketplace. If you're looking at charts, looking at indicators as a lesson, that you're probably going to have your first inclination is going to be wrong. And there's another thing about indicators. Notice that in the charts I've shown you, we'll go back and take a look. I don't want to drive this point home. Here's one chart. What's the purpose? To show cycles and timing. Here's another chart. What's the purpose? This indicator is seasonal. This indicator is small specs. This one's large traders. Each indicator on your chart must be there for a reason. And when I look at people's charts, what I see is a plethora of indicators. They have my percent R, my ultimate oscillator, my good buddy John Bollinger's Bollinger Band and Bollinger percent B and stochastics and RSI. They're all the same. All those indicators are giving you the same message. Throw away all of them but one. Just keep one on. When you put an indicator on your chart, you need to ask yourself, why is that indicator there? Why am I using it? Most of these indicators are terribly redundant. That's all a 14-day moving average of price expressed in one way or another. What I want to do is get into the insides of the market. Let's see if we can get another look here. Yeah, it's a small speculators, what they're doing. That's each indicator should be on your chart for a specific purpose. That's going to make you a lot better stock trader, commodity trader, because fundamentals matter in stocks too. We can see accumulation in the stock market. You can use on-balance volume. You can use a variety of accumulation techniques to be helpful for you in stock prices. So that's my view of the market as a kind of a little overview of the market. Bonds, we want to look for bullishness in here. Heating oil, we should go down until the first of the year. And short-term traders want to take sell signals, not buy signals. You see, we continue to see this market down, especially starting around first part of November. Cycles tell us that this market turns around and goes down again. Well, that kind of wraps it up. I hope that I've covered some bases that have been new to you today, that I've opened some doors in your thinking, and look forward to being with you guys and gals on a weekly basis here. And if you have questions, of course, you can feel free to ask them at any time or come to our website at ireallytrade.com. My weekly market commentaries are pretty much what you saw today. I'm going to give a trades forecast where I think markets are going, so I hope that can be of real value to you. The big thing, though, the big lesson I hope that you take away today is these charts all serve a purpose, and it's conditions that move the markets. It's not just charts. Charts show us where prices have gone. They don't show us where prices are going to go. It's conditions that move the market. And that's a huge lesson for you as an investor or as a short-term trader. It's all about conditions. We express those conditions on charts. Excuse me. The conditions are expressed there so we can get our view of the future. Well, that's a wrap up for this weekend. This has been our first live trading with Larry Williams. I hope you've enjoyed it. I thank everybody for having me here. I hope I've added a little bit to your understanding and your success in trading the markets. And look forward to seeing you next week or at ireallytrade.com.